Hey guys, in today's episode, we're going to be going over very basic level terms any real estate investor needs to know in order to get into the space. So without further ado, let's get into it. The first term we're going to be discussing is NOI, which stands for net operating income. All NOI is your gross rents minus your operating expenses. So basically your income before paying your debt.
So as you can see here, our NOI is our gross rents minus our operating expenses. In this case, our gross rents are $100,000 and our operating expenses are $35,000, which leaves us with an NOI of $65,000.
The next term we're going to be going over is DSCR, which stands for debt service coverage ratio. You'll need to know the previous term we talked about, which was NOI, net operating income, for you to know the DSCR. And all DSCR is a metric that lenders use to evaluate a deal. And the formula is your NOI divided by your annual debt service. Lenders typically look for a 1.25 plus debt service coverage ratio. This is a very important term to know.
All right, so here you'll just see that your debt service coverage ratio is just your NOI divided by your debt service annually. So if you have an NOI of 65,000, debt service of 50,000, your debt service coverage ratio is going to be a 1.3.
The next term we're going to discuss is equity. What equity means is essentially the property's value minus the loan on the property, right? So your equity in the property.
So again, in order to calculate this, we need to take the property's current market value and subtract it by the amount you owe on the loan. So in this example, I have a market value of $100,000, a loan of $75,000, which leaves us with $25,000 in equity.
The next term we're going to discuss is cash flow. And as you can probably guess, cash flow is just the remaining cash left in your pocket after you pay your debt service and your insurance and your taxes and any other expenses that you may need to pay. Whatever's left over is considered cash flow.
So for the entire reason I'm in this space, cash flow, the most important part of your business. This is just going to be the amount of money that's left over every single month after you collect all your rent and then pay all your bills. Cash flow is the king of all kings.
This one's very important, and this term is cap rate. It stands for capitalization rate. All cap rate is a measure of your property's NOI divided by the purchase price. That'll give you your cap rate. It is your gross yield on a property if you were to pay it in all cash.
So again, cap rate's going to be a metric that's used by investors that'll just calculate the yield on a property. And all you're going to need to do to calculate this is take your NOI and divide it by your purchase price. So in this example, we have an NOI of 100,000, purchase price of $1 million. So that leaves us with a cap rate of 10%.
One more term that's very important is LTV, which stands for loan to value. And this is literally the loan to value ratio. So the percentage of your property that's financed, which would be the opposite of your equity, right? So if you have 30% equity, then your loan to value is 70%.
So again, to calculate LTV, we're going to take the amount due on the loan and divide it by the market value of the property. So if we have a loan amount of 65,000 and a property value of 100,000, our LTV is 65%.
1031 exchange, which is very, very important for investors to understand. This is a tax-deferred exchange that allows investors to offset gains when they sell a property and buy another one. As long as the price of the property that you're selling and the equity that you have in it is equal or more in the purchase price as well of your 1031 exchange property or properties, then you're golden.
Again, 1031 exchange is just a tax break to defer your capital gains on any property sale. There is a few caveats to it. You have to wait a year in order to execute a 1031 exchange, and the property that you're exchanging into has to have the same or higher purchase price, and the equity that you captured has to be rolled over as well.
And the last term we're going to talk about is cash on cash return. Cash on cash return is your annual cash flow divided by the money you invested, right? So
here's the formula for cash on cash return. And obviously you'll see you just have your annual cash flow divided by your cash invested. So if you have an annual cash flow of 10,000 and you're 40,000 in, then your cash on cash return is 25%.
And that's really all I got. There's obviously plenty of terms that you need to know other than those, but those are some very, very basic terms that can help the average investor underwrite deals and do the things they may need to do. So Subscribe if you haven't yet, and I look forward to giving you guys more knowledge.